My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content.
All right, guys, welcome back to Property Profits Podcast. I'm your host, Bryce Kaminsky, filling in for Dave DeBow. And have you ever wondered, the $1 million mistakes lurking in the real estate investments? Today, my guest, Mark Ainley, hailing from the bustling Chicago market. He's here to unravel the mysteries behind possible costly blunders and his rise, as well as he's a host of a major podcast. Mark, welcome to the show. Thrilled to have you here.
Bryce, man, I'm so excited. I've been listening to all of the episodes. You guys have such a great, you guys have done 700 plus, and anytime you get past, it's just amazing what you guys have put together and the audience you have following you. So I'm excited to be part of this.
Yeah, I mean, it's we process it, we process them, we get as many people as we can, and I love hearing the stories across North America. You never. It's like you can only imagine what you can imagine. And then when someone says, this is a fact, I have 1,600 doors in Ohio, and you're like, okay, so that's actually within the realm of possibilities. And it really, for me anyway, and I'm sure people listening, the perspective is really inspiring. So I can't wait to dive into this with you. So how did you get started in real estate?
Well, I was growing up, I'm 43 years old, and I was growing up, I used to want to be a stockbroker, and it was more the thrill of Wall Street and money and all that stuff. No other reason than that. But online trading comes on, and it just seemed like a dying industry. And I ended up buying I bought my first property, and I was 21 years old, and it was something I lived in. And the word house hack wasn't around back then. And I ended up having my friends, they got kicked out of their house for whatever reason from their parents. We're all pretty young, and they come stay at my house, and I charge them. And all of a sudden I found I was paying no mortgage. I'm like, oh, this makes sense. This is the rental thing. This other people paying down your mortgage. At the time I read Rich Dad, Poor Dad right around that same time. And then I bought my first investment property not too long after that. I think later on when I was still 21, and I messed everything up. I bought it at the right time, but I bought a property, put the wrong tenant in there, messed up my numbers, ultimately let them move in with all the things you do wrong, with partial security deposit, and didn't do a background check, and ultimately did a modern day cash for keys after I filed for eviction. And I said, I'm never going to manage a property again. And I said, I'm going to go back to brokerage. So I started selling. But as we were selling, what we were really good at was selling investment properties. So it dragged us back into the property management. And, we now manage about 1,500 units here in the Chicago market. Plus, during kind of that '08 to 18, we basically did that burst strategy. We did that 482 times. And,
Wow.
We kind of turned a little turnkey business there on accident as well, too. And then we sold some of those properties, and we buy some industrial now. And now we're just kind of going back to what I think is a hot commodity here in the States, is the whole kind of Class A single family home based on the lack of inventory.
Yeah, well, and I always say, having coached people into like the flipping thing back in the day, 2015, 2016, 2017, there's nothing like, yes, duplex, triplex, mobile park, all these things, but nothing is more valuable in the world of real estate, than a good single family home. There's always going to be someone who's like, I want to move my family into a home. And that's always a great ticket. So, uh, especially with the supply and demand now. So are you burying these things and holding them, or are you flipping them out and bringing product to the market when you talk about the Class A single family?
Well, I've been doing it for 20 years. I think to listeners out there, my biggest regret, and I kind of came to this about a year ago, about a year and a half ago, and my biggest regret is I've sold too much. I
Yeah.
wish I would have held on to more. I sold that. I got some money in the bank. I got more properties. I got assets, but it's like, that property today versus everything it would have done for me between the principal pay down, the tax offset, the hedging for inflation at 3 and 4 and 5% type rates. Like, I sold too much. So kind of going back into this single family model is something that is I don't know. I just, like you said, there's not enough inventory out there. And I think this 200 for here in the Chicago market, this 250 to $350,000 single family home in an awesome neighborhood.
Mm-hmm.
You hear a lot of bad things about Chicago. There's plenty of areas we don't go into, or plenty, even a whole county.
Every city's got their own uh no buy zone, or what we call the red zone or
Yep.
the war zone. Every city's got a war zone, and just play on the trenches, like right on the other side where maybe it's still affordable and people are still transitioning. Do you have a particular target? Are you renting these things now?
Yeah, so we're renting them out. It's hard nowadays. I think that the hardest part is finding the deal. And I think over
Mm,
my network, I think one of the biggest things I did over the years was never screw anybody. Because
yeah,
I think now
real
all these
estate
relationships I
karma.
built or never screwing anybody and never telling everyone how I thought at the time, because a lot of times it didn't make sense. Maybe I didn't like how somebody did a deal or something like that, and just keep my opinion myself, because later on I became good friends with them, and just more
Mhm.
because I had bad reading judgment book by its cover early on in my younger immature ages. So helping us find that's helped us kind of find deals now. We're putting kind of doing called moderate, call it 50% gut rehabs, and then putting a solid tenant on. And our goal is right now to burr out, get a majority of our money out. Meaning, if we got to leave a few percent in there, we have the
Yeah,
capital to
five
do that.
grand, 10 grand, or
Yeah,
something like that. It's
and
going to be
then
parked.
yeah, but our goal is to not have to touch it for maintenance or capex. Capex for 5 years and maintenance at least for a couple of years.
Yeah, and that's the big thing. Like, it's not there's a difference between flipping and burring, because when you're flipping, it's like a lot of not facades, but it's all in the like emotional positions. But when you're burring, it's like we didn't when we were burring, we wouldn't even like think about the furnace. We'd just be like, new furnace, new hot
Yep.
water, waterproof the basement if it has one, because these are the things that we want to avoid for our clients, especially if you're doing the property maintenance, which we were. We don't want to have that call. Like, we don't want that call, and we want this thing to be stabilized with the tenant. Now, tenants aren't stable, but the building hopefully is stabilized for a term that can be profitable, pull that extra like 10 or 20 grand that maybe got parked and get it back, within a few years. So when you're looking at all this managing, all these units and dealing with the investors who own these units, how do you ensure like seamless client resident experiences with the property management company?
Um, I mean, it's property management stinks because it's a service industry and a product industry. You have to service the
Yeah.
people, and then you got the product is your units, and
Mhm.
so it's just a difficult. If I could do it again, I probably would have got into it. But I've kind of in a bad, disgusting way, like love it in some weird way. But I think it's very process driven and it's very repeatable. So just our ability with some of the tech we've applied, we've been able to be able to grow to 1,500 doors and not have a chaotic situation. Because, a lot of people grow with property management, and I've been there. You grow it where it's like, now things are starting to fall through the cracks, and it's always trying to figure out how things don't fall in the cracks. Or, as you grow, you have people that specialize in certain areas. Maybe one guy does lease renewal, one does collections, but the handoffs and kind of that's where a lot of things get messy. And we've worked really hard to try to cover up all those kind of gaps.
Yeah. Well, it's especially with um, the tenancies. We have property management. We've changed property management on our units, and it seems like transparency is key.
Yeah.
What's going on with my house. So how do you manage the transparency with your investors as to like what's going on with my five rentals?
Well, for us, a couple of things. So transparency and responsiveness is the big one. I worked on the sales side of the property management, and it was always the people that's like, "Hey, I never knew what was going on," and owners or investors never assume like, "Oh, I bet you everything's perfect." They're always assuming like, "The guy never comes back. He's not even watching my property." So our ability to be transparent on what we're doing throughout the process has been key to like keeping our clients happy. And then the responsive piece. If you call me up, you got a question. Our staff always ask themselves, should I have told them that already, or should they have known that information not to have to make them come to me? And then
Hmm.
two, if it's just general inquiry, how fast can I get back to them with their answer they want so it's easy to do business with us?
Yeah. the responsiveness too, because sometimes, with the eviction process, um, landlords are trusting that you guys are working for them and not the tenant in this particular way. Because like tenants come and go, but the property remains. So when it comes to like the eviction process in Chicago, what do you guys do to maintain that? Because we got to keep the vacancy down. That's like the thing. We want a full unit that's paid every month. And yeah, toilets leaking, whatever, that stuff gets covered. But the biggest hit, I think, with the single family specifically is vacancy. Because a duplex, okay, half is down, the other half is still rented. But the single family, so how do you guys mitigate or within the laws, the tenancy laws, to make sure that the tenant situation is on that you're on top of it?
Well, I think a lot of it we learned early on was the screening. If you put the right person in the unit, then that I always tell our clients, like if we put the right person in there, that makes yours and our relationship a lot smoother. So that screening part, the amount of energy versus the amount what we get paid for is it
On the
definitely
back.
exceeds
Yeah.
it. Yeah, like so that front up front, we turn our lease team, our screening team, the tech, the software, the due diligence we do, like that's huge for us. We're really excited that last year we didn't have to evict we didn't file for eviction on one person that we placed. We inherit people and we end up in
Hmm.
eviction a lot of times because of that stuff, or people hire us for that reason. But so that's the first part. But then it just comes down to having the system. For us, if you're over $1,000 and 31 days past due, you get the hand delivered 5-day notice through the process server, and then we go from there. And just making sure that we follow that same process every time. That way we could tell. Back to what you're talking about, the investor. A lot of it's just knowing what to expect. So setting the expectation, and then following our own expectation, because that's really
Hmm.
easy to mess up when you have a bunch of people. It's like, all right, well, you told me to do this. Yeah, I know that is our process, and we actually internally screwed it up. So so two things: one, make sure we're setting it, and then two, make sure we're managing to it internally.
Yeah, because one of my colleagues, he works like nonstop. So he's like on his business all day and he puts his money into his rentals. And he says, "Look, property management is there so that I don't have to play defense on my units. Like I can go to work and know that they're working on my things. And if it starts to slip up, the value proposition can slide really quickly. Like, what are you doing then? What are you actually doing then if I'm having to address these things? And one thing, and maybe you could speak to this, when you're getting pressure from a landlord to say place someone, how do you push back on that screening and say, look, I want to place someone just as bad as you, but how does that conversation go?
Well, a lot of times that comes down to listen, if we price it right and it shows well, we should be able to get rented in a few weeks. Just that's pretty much the truth in the last 7, 8 years here in Chicago. So usually it comes back to because we do have clients that do that. And a lot of times it's like, hey, let's try getting $200 higher, or let's not paint the place fully this time. So a lot of times those conversations come back to that. And now it's our job up front, like, hey, listen, we won't paint the place, but you're probably going to get 2,100 versus 2,200. And then if they still want to push your 2,200, then at least we're on the same page 4 weeks later when it's like, hey man, this has a rent because we probably should be around 2050, and you didn't and the place doesn't show that well. So again,
Hmm.
it comes back to a lot of expectations with that stuff. And then so if we actually here in Chicago, if you overprice it, it's actually even worse. We get a lot of just crappy tenants. You get crappy tenants and government subsidized tenants. I'm not saying
Yeah.
government subsidized tenants are bad, but bad tenants and government subsidized tenants have trouble finding housing. So I always say if you price your place right and it shows good, all the best tenants, best qualified people will flock to the nicest, cleanest
Hmm.
places, and it leaves everyone else to find whatever. And I always tell clients you don't want to be in the whatever bucket because you take time, then you end up making a bad decision by putting somebody crappier in there, and then all of a sudden they're moving out a year later, and now because there's a crappy person, you have a heavier turnover. It's a horrible cycle of suck.
Yeah, we're doing a rental renovation unit turnover. Paint this, fix that, toilet seat this, caulking that. And it's not, like the turnover can cost you, depending on your cash flow on the unit, it could cost you most of your cash flow. So you want to keep those people long term. Now, let's pivot a little bit. Um, we talked a little bit about the finding real estate deals for your substantial growth that you're talking about. Um, are you going to have to expand outside of Chicago into the suburbs because of inventory? Or are you finding that, at least in the foreseeable future, that the inventory you're looking for to burr is around?
You know, we manage stuff all around the Chicago metro area, but most of the stuff we're investing in is outside of Chicago. Between Chicago and the county it's in, which is Cook County, there's a lot of politics, and it's just the level of doing business and the long term investment strategy is more of we'd rather be in one of these top suburbs of Chicago that almost have their own little economy as well too. So, yeah, that is, most of what we are looking at is call it these 30 to 60,000 people suburbs that have the kind of 250 to 350 starting point, low end. What we're buying is these smaller ranches, but we're confident that pricing between new construction, what it costs to do that, and then just lack of inventory will pull up these prices just naturally. The bottom will rise.
Yeah. And if the Fed cuts the rate, man, the prices of property, like I've been saying that for a while to people, and they're really, it's falling on deaf ears. If you can capture things in this valley, let's say that maybe we're coming on up maybe a little bit. We're still in a valley of equity because of the depression against the interest rate. And so if you're able to, like, I don't know, buy 10 burrs and just hold them, what do you see your portfolio valuation? Like you were saying, I wish I would have held everything for ever. When I think back to 2015 when I started, being able to buy a property for like $51,000, that property, that's not a thing anymore. And that mortgage would have been down to like 32, and the rent would be like 1750 now, and I would have been doing really well, but I flipped it. I went short. I think we made 5 grand. Big deal. Congratulations, 5K. So when you look at the greater area, what would your advice be to people who are like maybe a little hesitant to start investing in these buy and holds for two reasons? One, I don't want to manage it. Two, I don't think the bottom is here yet. What do you say to that?
Well, I think so. Like I said, I've been doing 20 years, and I've watched. There's been a whole new level of investor that's came out since the crash, since 2009, 10, 11. It's just basically the younger generation, call it 35 and younger. They never were around before the recession. They never saw the 8%. Like when I got in the market, these were what the interest rates were. So this is not
Mm-hmm.
that crazy to me. But, um, it was 15, 16, 18, and so many conversations like, oh man, I'm saving all my cash. I'm waiting for the market to drop again. And it's like, man, it will never drop because you're saving up all your cash. When it was 2008, the market crash here in the States, everyone was all in. I don't know how, but I was walking away 110% financing. Like I would literally get checks back at closing. Like I was selling to people that were making 30 grand a year, and they had 7 investment properties that all had these kind of subprime loans. It's like it was a mess. Like there
Mm-hmm.
was reason why that was going to crash. And I always tell people, like, if you got cash right now, you're not the only one. And we all know the whole capital markets. There's just a lot of money out there. I mean, you guys know that more than anything. So until that 2008 happened, or those prices fell because there was no capital. And then here's the other thing that happened. I'll tell you one more thing. Between '08 and today, it introduced the whole Wall Street investor,
Mm-hmm.
where if prices drop 15, 20% right now, who's going to come in and buy all that? It's going to be Wall Street, all these different hedge funds and all that stuff, because they got plenty of money right now, and they will
Oh
pick it up
yeah.
all day long. And they're not looking to get 8% or $700 a door cash, which means that there's a floor. There wasn't a floor in 2008, and that's why things went so far down. And now there is a floor where,
Because they're looking at it like trading, like there's like an indicator. It
yeah,
went below this, auto buy real estate below this
yeah.
marker.
So that's your everyday investor's competition now, where it's like if you wait on, what are you waiting for then at that point? So I think so on our podcast, one of the questions we always ask is one of our 5 at the end. It's what's one piece of advice you give a real estate investor in Chicago that hasn't bought yet? It's always like, just do it.
Just buy.
Just get
I
it
heard
done.
this thing. It was like, when's the best time to buy real estate? And the guy says, it's the wrong question. What's the best time to own real estate? And he says, always.
Yeah.
So, time in the market, especially when you're looking at burrs and you're looking at, say, you've got a W-2 and or a T4 if you're in Canada, and you're saying, I'm going to keep working this job for 10 years, but if I bought this house over here and I held for 10 years, it should appreciate, we see, like you're talking, it should hedge inflation at bare minimum, the dollar to dollar, 5% or whatever a year, whatever they're saying the hedge is. And in 10 years, there's the pay down, plus there's the increased value of the actual like property now. So it's, you buy 10, can you be a millionaire in 10 years?
Yeah.
$100,000 of appreciation over 10 properties over 10 years. Can you be a millionaire in 10 years on 10 properties?
Yeah, I've watched a lot of people in the last 15 years. Really, like they had that like one property year and pay them down, all that stuff. Like, well, all of a sudden they get 10 years out and they're like, wow, a couple. Usually, if you buy 10 properties, usually 2 or 3 of them like are home runs. The rest of them just are kind of standard. You get a couple home
Yeah.
runs in there where it's like, wow, all of a sudden I have $1 million in equity or a million plus in equity. Now I have options. Maybe I don't want to do this W-2. Maybe I want to be a real estate agent, but now I could sell one property, live on that for 2 years, and then I could start exploring this full time. So, talk about the freedom or giving you options. That long term holders will give you options because the flip and wholesaling,
It's a treadmill,
it's
man. It's a treadmill.
yeah. Same with my property management. I still I make money on it, but I still have it's a job.
Yeah,
And
someone's got to do it though.
yeah.
It's not an optional industry. Some people want to self-manage. I think that's the most costly mistake in a rental business because like one bad tenant and your property management, like what do you charge a month on a unit?
Yeah, it's like $150. So a lot of times, if anything,
Okay.
you're buying
So
your time
like
back.
5 grand in damages for placing a bad tenant or 5 years of property management. Which do you prefer?
Yeah, no, for sure. That or just offset your time, the opportunity cost of
Yep.
it takes 20 hours a year per unit to manage
Mhm.
what you could be doing with that time. And that's a non-turnover year.
So tell me about the podcast. Nearly 300 episodes under your belt. What have been some of the most enlightening conversations, lessons learned on your podcast? And first of all, what's the name of the podcast?
So straight up Chicago investor. We started this right before COVID. COVID wasn't even in sight when we started talking about it. We've always been on Bigger Pockets, and we've always been me and my co-hosts contributors on there. And my first podcast I ever did was actually Bigger Pockets back in 2014. But
Nice.
there's nothing local. There's nothing hyper local, and Chicago's got 1 million rental units in it. They're about
What's the population there? Like 7 million or 5 million
so
in the
when you take
greater?
in the suburbs, you're probably about 9-10 million, and you got
Yeah,
about 1 million
right.
rental
Like
units.
Miami's 12 million. Chicago is so dense. Like anytime you go and you see, what was it? Like it's like 8 lanes going each way. That's how you know how big it is. How big is
Eight
the
lanes.
interstate? 8 lanes both ways, 16 lanes in total, right through the middle of the city. That's how many people you got. I think
So
Miami had like the same, 14 or something.
yeah, so timing wise, there's nothing else out there. I thought for sure someone would have something I just don't know of. But then we said, let's do it for a few episodes, and here we are, almost 300 later. But it's been great because it helped me network with so many people I never even knew
Yeah.
existed. And then it's
Yeah.
out, and so many people I knew my friends, or so many people my friends referred me to that I never even knew were in their network. It's like, man, you never told me about this guy. Like, so it's been huge on that, and the lessons, and we've kind of built a little community around here in Chicago. We've had some fun guests on there. David Green for Bigger Pockets was on a few weeks ago, and he talked about a horror story he had about losing 50 properties due to some fraud type issue. But like, I don't know,
Wow.
our goal of the podcast is not to get people on there and say, "Oh, I did all these wonderful things, and you could be me too." It's more of like, how horrible did you feel the day you got the stop work order permit and the second time? Like, we really want to dig into the pain points of where these successful people, they're all successful, made mistakes. I would say when we did those 482 properties, I made $1,000 mistakes, which is $1 million, which is I lost $1 million. Like that's what I want to talk about. That's what I want people to hear about.
Yeah. Well, and that's the thing too, is that as real estate investors, I think we're a little guilty of like walking around with our problems in our pockets. We're not like, hey, look at my problems, because it's kind of promoted as like everything's great, everything's awesome. But the reality is that you don't learn anything from that story. When someone's like, oh, I'm doing great and everything's great, and I'm not talking about the tenants and how that last tenant beat up my unit, but that story is more valuable to the community. Whenever we do a community meetup here in Manitoba, I always say to the room, is there anything that anyone knows that can benefit the group so that we don't all have to step on that landmine? And then people will be like, oh, this or interest rates that or mortgage rate, mortgage broker this. And we can all like avoid one problem that month. That would be great. But we don't
Wow.
learn anything from wins.
Bryce, I will guarantee that in your career, you've learned more from listening to other people's pain or causing your own pain.
Oh
Like,
yeah, I've That's my big thing. Never go unconditional. If you're a wholesaler listening, don't go unconditional until you have the money. I've lost all my money in that particular move where I thought I knew more than the market. You don't. The market always knows better. They're the house. It's a casino. The house always wins. So don't pretend like you know better. That's the lesson for everyone out there. So you mentioned crossing the 8 digits in revenue with the property management company. What do you think attributes that success? How do you plan to sustain that into the future?
Well, I think for our industry, for property manager, we serve investors, right? We serve about 500 investors, and our goal, we can never be profitable on our investors' backs. So our goal ends up being, how do we vertically integrate to provide more services? Maybe we can make
Mm,
money, but at the same time, our investors could get a better level of service or additional services that they might be paying for somewhere else.
yeah.
And I think that ends up being how you build a good business that is more horizontal than deep. So
Yeah, because I think, the more the bigger you get as a management company, maybe you could speak to that for a second. The bigger you get as a management company, the bigger the cracks can be. Like hiring people is always tricky. Um, Giving them the standard operating procedure and being like, okay, everything's good, but then the human nature of things starts to creep in as the organization grows. How do you keep that clamped down and tighten up those cracks? What do you guys do on a yearly basis? What sort of audits are you guys doing internally to make sure that it's tight, it stays tight, and that the value is still there?
well, I think a couple of things. One thing we started in 2017, we started running off of EOS, which is an operating system off of the book Traction. So just helping us grow and figure out our issues we had on a weekly basis and setting up to do's has been huge for us. But two, we've also, it's very, you just said it's very labor intensive. Like there's been some tech enabled property management companies out there that have came up and some of them failed, some are out there, but it's really tough outside of class A, kind of high rise condo type stuff to really go all tech. There's just that human element
Well,
that
the thing that about like property management that relies on the tech is like your tenants are not setting up an account. They're calling the front desk. It's like trying to get an old school contractor to use something to like send you pictures. His
yeah.
flip phone doesn't have a camera. So
Yep.
how do
Yep.
you guys navigate that space?
Yeah, well, so I guess you have, yes, there's tech right involved, and we do have some
Mhm.
tech, and whether it be front facing, the client facing, or back office, and we
Yeah.
try to leverage the tech as much as we can, so we could put all our resources into that client facing, helping that client sign on. Like, if we could leverage our time with tech behind the scenes, then that helps us only just be front and center. Now, we have 60 people that work for us, and 30 of them are over in Mexico or Philippines and that, so we able to just apply more bodies to problems. Now that turns into management issues, internal manager issues. Sometimes if you have more people manage, and more complexity, especially around communication. But we've been able to, something our property management industry has been able to do, is leverage global talent.
Yeah. And what's nice about that too is you can get like full-time support because the time zone difference. We've got
Yeah,
some people on our team that are overseas and they're messaging me at 2 in the afternoon where it's like 5 in the morning there. So we've got this like coverage that you'd be hard pressed to get someone to man the phones at the local Chicago desk at 3:30 in the morning. Like who's answering that call?
yeah, exactly.
Someone maybe in the Philippines because it's 9:30 in the morning. They're like, "Hello," and they just woke up, had their coffee. It's 3 o'clock. My toilet, and they're like, "I'll help you right away, sir."
Yep.
So that's interesting is like leveraging, and you're seeing that too with the scale is the global competition in that space of assistance. They're wondering, oh, why can't I have that job? Well, it's not cost effective to your landlords. That you can get different varying wages depending on where these people are from and how much value you can get for the dollar, especially as an American dollar exported globally. It's one of the most highest traded. I mean, other than like the UK, where that's a whole other thing. But when you have this like global management, what sort of like software are you able to wrap everything in? Not to give out the trade secrets, but are you using a software to keep that communication tight, or is it a command structure? What is it that enables your success?
Yeah, we built out a whole platform on Podio. So we've
Nice.
been, when we were doing all the construction before, that's how we started using Podio. And like, this is kind of be a good, because we use Appfolio for our property management software, but it doesn't have all of the, I always use example, our turnover process or our lease renewal process, like 13 steps across 3 departments. But in Appfolio is always done or needs to be done. So it's like you never knew what stage you're in. So we started building out Podio many years ago, and we use it for all different facets, which obviously everyone can get access to. And then with VoIP phones these days, advantages it all kind of ties in with being able to stay connected globally.
Awesome. Awesome. So with your upcoming expansion in the Burr area, it's going to take probably some new capital. You probably have some capital ready to go, but we could always use, there's always people saying, "Oh, I want to buy a yacht. I want my 100K back. I'm getting married. I need my money back." So there's like a natural turnover to the thing. What are you guys doing to get more eyes on the prize and get more investors looking in your direction to raise that capital to expand that Burr project you're working on?
Well, we have a good platform as far as the podcast goes, and obviously, I
Mhm.
think some of the best, like I said before, just keeping the network and having options with people, and then at the same time building in the cost of capital into your project.
Yeah.
If it costs me a couple more grand to keep an investor that's really easy and just wires the money over, I'd rather pay that versus have to go look for someone that's going to be a little more diligent and want things recorded and like all that stuff. So I think when you have something that works and someone that's easy and it costs you a couple more bucks a turn, or that's huge. I ran into the opposite issue though, of like people won't let me give their money back because they don't know what to do with it. So helping
Yeah.
them keep their money, making money will always help you for when you actually really need it.
Yeah. And that's interesting. I've done tons of podcasts. I think even for myself, I think where I'm at like episode 3 something. And you're one of the first people to say, "Hey, I'd rather pay." That's interesting. So people listening, I'd rather pay a little bit more for easier to deal with people than to get a great return on to get a like a less of a return payout for a troublesome, not a troublesome, but like a more taxing investor because they come in all sorts of shapes and sizes. One guy wants to go and be on site, and the other guy's like in Mexico and he could care less about what it is. So you prefer, especially I guess when it's so big, you don't need John Landlord hanging out telling your guys what to do on site while he's doing like some landscaping or whatever, right?
Yeah, our biggest thing, I think for when we're looking for somebody, it's they're just worried about making sure they're confident they're going to get paid back the principal, but they're really just want to make sure that they have their money working for them.
Yeah,
And
that's
they know if they
deployed.
work with someone like an investor like us, like it's going to keep turning. And I guess sometimes they want to know like, hey, is this the only deal you're going to do? Because maybe I'll go put my money somewhere else. So if you're able to also paint, I always try to paint a picture like, hey, if we get this one done, it works, and you're happy, we can keep doing this. Oh, really? We can. So that kind of will
Yeah,
help.
I'm in the business. I'm in the
Yeah.
business of business. I'm going to keep doing this. I'm not just like a one and done guy. We're going to invest your money and we're going to keep it running. So that's interesting. So on that point, I mean, if people want to connect with you, they want to find out more, what should they do? How do they find you?
Well, you could definitely, probably my best way is LinkedIn. I communicate a lot with people on there, or check out our podcast, Straight Up Chicago Investor. We are specific to Chicago, but very Midwest. So any Midwest investors, we have about 80% of our people, our listeners are in Chicago, and the other 20% all around the world. So, yeah.
Very cool. Very cool. Well, I really appreciate you stopping by, man.
All right, man. Thanks for having me. It was great.
Awesome. Awesome. Until next time, guys, we'll catch you on the next episode.
Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewyou.com. Now at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.